I'm Dan Fitzpatrick at StockMarketMentor.com on Tuesday, July 10th. And in this free video here, we're going to look at Merck. Dividend yield, 4%. That's pretty good. A lot of the pharmaceuticals are up in the high threes. Merck is finally at 4. So are you going to buy this stock even though it looks to me like it's pulling back? I mean, we almost have a bearish engulfing pattern. Not quite. But almost. If the stock had actually gapped up above yesterday's range, like right to there, and then did what it did, well, this would be really, really bearish. As it is, it's just really bearish. Like, I don't want to buy this stock right now because it's down almost 2% today. However, does that mean the run is over? Remember, 4%, that's fine. If you're going to hold the stock for a year, you get paid 4% for doing that. I guess it's better than a U.S. Treasury, but in fact, actually, I guess it's probably safer than that too. However, if the stock declines 10%, well, that 4% doesn't really get you much, does it? So you have to look at the price chart. You can't just go, snapping at a 4% yield on a Dow component just because somebody tells you to do that. Stop and think for a minute. Stop and look. Here, we've got the stock that's come out of this range. It looks like it's totally been overdone and should now pull all the way back to here, right? Okay, maybe, but look at the weekly chart. Weekly chart, you can see this has been consolidating for like 2 years. And this here, look how tight the Bollinger Bands are here. It's a little volatility squeeze. Bam. Stock starts blowing out on increased volume, not increasing. Volume's actually kind of declining now, which is typically what you're going to see when a stock like this breaks out. So it's in a volatility squeeze in the first phase of expansion, and that does this. Let's just mark this thing out so we have our plan. Here's the squeeze. Members, I know I talk about this all the time. You're going to hear me talk about it once more. First phase is the breakout. The second phase is the test of that breakout. That test could come all the way back down here. This might be it. Doubt it. And then the stock's moving higher, or the stock can come all the way back down and absolutely fail the test. The breakout turned out to be a fake out. You don't want to buy the stock. Happily, we don't have to make that determination right now. Instead, we just know that this phase 1, the initial breakout, is over. Now we're going to watch and see how this stock acts. Will the stock continue to fall a bit more? I believe that it will, but probably not too much more unless we get a major implosion in the market in general. Why not? Well, because this is about as defensive as it gets. I mean, we got the Affordable Care Act, or whatever it's called, that's now going to be going into effect. Well, guess who benefits? Merck, Pfizer, all the other drug companies who were secretly, in bed with this whole thing from day one. That's not a political commentary, guys. That's a market commentary. The druggies are going to do just fine on this. So this is why Merck has been bought up. It's not a political thing, it's a money thing. So how are we going to benefit from this? If you're long the stock, you better be long it for an investment and not just a quick trade. But if you're looking to get in, I wouldn't buy the stock yet. I would not buy Merck here at 41.37. I think you'll get some kind of a pullback below 40 anyway, or let's just say if it pulls back to $40, that's when it'd be a good opportunity to start accumulating this position. But remember, the weekly chart is really what you want to be looking at in terms of holding time for Merck. This is not a short-term trade. This is a multi-month trade. I wouldn't own it just to get 4%. I don't really care about a stupid 4% yield on a stock. It hardly gets my attention. What does get my attention about the 4% yield is that I know it gets other people's attention. It gets big investors, big money managers' attention who want to hold these high dividend stocks. They're going to look at 4%. They're going to like that. They're going to want to be long the stock. And also, as Merck falls, if it does continue to fall a bit, that yield gets even more juicy. So what this really does, what this yield does, is create like an underlying bid for the stock. When the stock comes down, there's always demand underneath. That is why I think Merck is still a stock you want to buy. I think you just want to buy it on a dip. Okay, members, get to the strategy session. Tonight's theme, what not to do right now. I'll explain when you get over there.